This podcast is produced by Linear B Group, the brand, content, and account-based marketing agency for the private capital industry. You're listening to Fund Shack. I'm Ross Butler, and today I'm speaking with Fatou Diagne, co-managing partner of Bootstrap Europe, a provider of debt funding to high-growth technology businesses. Fatou established Bootstrap alongside co-founder Stephanie Heller in 2015. In 2023, Bootstrap acquired the German portfolio of Silicon Valley Bank. Fatou started out in investment banking with Citigroup in London and Johannesburg, and after that, she managed private equity and venture capital portfolios for family offices and multi-asset managers. Fatou, welcome to Fund Shack. I wonder if we can jump straight in to the technical side of venture debt, because not everyone will be that familiar with it. What types of companies are you looking for, and what kind of terms do you tend to offer, and time horizon and so on?
Thanks, Ross, for having me, and thanks for the question and jumping straight into the topic. At Bootstrap, what we look for is to finance with debt companies in the technology world that have already received funds from equity growth capital funds, usually, and who can raise equity but choose not to dilute themselves for specific reasons. I'll come back to the reasons, but specifically those type of companies are around 5 to 7 years old, so they're not super young startups. They are growing 100%, revenues of 5, 10, 20 million. They've already received substantial equity funding to the tune of 30 to 40 million. And they want to either accelerate the growth by replicating a well-honed formula of growth that they have, or they want to bring forward certain milestones. Then knowing the really good formula that they have for growing, they can decide to take gross debt, which is, borrowing €1 of gross debt is going to create maybe 3 to 5 euros of revenues, and that's going to be valued at 50 euros. And that's a relationship that is solid. They're backed by very good expert investors. We like technology that are a little bit nerdy. So the recent deals we've done are in semiconductors, in life science, in the energy transition, because we believe that those technologies have potential to make a step change in the way we live, the way we work, and address some of the challenges that we have as a society.
So it sounds like you're actually after like the creme de la creme of venture capital portfolio companies. And well, maybe it's a bit unfair of me, but when I hear venture debt, maybe it has other connotations. Is that the case, that you're looking for, really the top flyers?
It's true that there is this misconception that companies who raise debt do it because they haven't managed to raise equity. It's really the opposite. Knowing that, as a fast-growing technology company, you're often cash flow negative. You do not want to load your ship with debt if you can't afford to repay it, if you don't understand exactly the purpose of that debt. So effectively, if you look at the total universe of companies, first you have the ones who have to be invested with venture capital funds. That's already one level of selection. And then out of those, there will be maybe 1 out of 10 that would qualify for debt because of the level of maturity, the growth rate. And most of the time, we ask for the right moment. A company could be perfectly fine for debt in 3 years, but not today, while it's still figuring out, let's say, the go-to-market or the product market fit or the unit economics.
So it's not just the type of company, it's where they are on their journey. So presumably you're tracking a lot of companies waiting for the right moment.
Right. And that's why we often refer to that venture debt as gross debt, because what we really want to do is accelerate that growth that the companies are having. I think some of our best investments, we have followed them for 3 to 4 years before we invested, because we identified the quality of management, the quality of the technology, the market they were addressing, and we were just waiting for that right inflection point to help them grow faster.
How many rounds of VC have they normally had by the time venture det's right for them, or your venture debt?
It depends. So it's usually 1 to 2 rounds of professional, VC investments, so Series A and later. It used to be Series B and later, but companies have really matured. You have repeat entrepreneurs, you have really professionally organized companies.
So it's fairly early.
It can be quite early. Sometimes you have also technology companies where the IP the intellectual property has been in preparation and nourished within research institutes for sometimes 20 years. It then gets transferred into a commercial companies. that sometimes has contracts from the get-go, and those you could invest at seed round, and which we have done.
So in one sense, your deal flow is quite easy because you're looking for the top VCs and the top companies at the right stage of their journey. What about what's in it for them? So who comes to you? Is it the VC? Is it the portfolio company? What value do they see in the product?
So it comes back to the issue of dilution. In venture capital, you need to raise sometimes a lot of money to dominate your market or make a successful exit. And on the way, I think the average holding of a founder, at exit is somewhere around 10%. If you sell $1 billion company, compared to the outcome, you have a relatively reduced portion of the upside. And same for early stage investors, right? If you have been in the seed round, you need to follow your money all the way through the exit in order to get, a sizable return. So often it will be anyone who's sensitive to dilution around the table, and that's often founders and their investors.
Particularly the seed ones without deep pockets, I assume. They must love you.
Yes, the seed investors do love us, but all through the value chain. Because even if you are a C round investor, instead of putting, let's say, 100 million, if you get to put 50 for the same outcome, you've doubled your multiple. So really sophisticated investors will bring us in. As is 2/3 to almost 90% of our deal flow comes from the equity investors who are supporting those companies because they don't want to be diluted. They don't want to open the cap table to other investors. Right. So they don't want to share into their best deals.
Yeah.
Sometimes they don't want to price the company. So they're about to sell it to a strategic investor. The last thing they want to do is create a valuation event right before the exit. And so instead of doing an internal convertible round where they have to go to every single person and inform them of the sale, they can just quickly put in place a gross debt round.
Ah, very cool. Our sponsor for this episode is RW Blears, a UK law firm specialising in venture and growth capital. What sets RW Blears apart? What's your value proposition?
We've got a very dedicated service owing to that one-stop solution for fund managers where it's quite rare to be able to provide the end-to-end service in respect of, for instance, fund formation. So I think clients take particular stock from the fact that we're there from the very start when we're structuring right the way through to transactions and then obviously wind downs of portfolios and exits. So I think that's something that they greatly value as opposed to perhaps larger firms where there can be a little bit of ping pong between departments.
I think that's right, exactly. It's the combination of all those three things, corporate tax and regulatory, the three things you need really to launch and manage a fund. But we don't really go outside that. We're not trying to be full service. We're a specialist. Those three areas keep us more than busy enough, so there's no real need to try and be something we're not. We remain a specialist at heart. But we do need to cover all three of those bases, and all of us need to know all three things, basically. So that's why we don't have to bounce people around from department to department.
Given the challenges in the market, are you seeing in innovations on the fund side?
I'd say two, actually. The first one, a couple of our clients are involved with, which is platforms, and so assisting with feeder investments into larger funds. And so as the tech develops on that front, it is something, as Frank alluded to earlier, that is very much within the eye of the regulator, and hence that's where we come in to get right. It's a positive development and it's certainly an innovation. Secondly, secondaries are making their way into the venture capital market more so than before. It's releasing pressure, I think, particularly on later stage VCs to distribute capital to their LPs in the absence of other options, given our fairly anemic public market in the UK at the moment.
In the section of the market that I tend to deal with, which is, as I mentioned, is EIS and VCT, it's not so much that there are innovations in the structure of the funds, it's that what drives deployment is the rules. For instance, in the case of VCTs, you actually are required to deploy 30% of your capital within 12 months. And for EIS, because the tax reliefs aren't even available until you start investing in the companies, there can't really be more than a 12 to 18 month lag, or you start getting irate investors coming to ask where's my tax relief. So in a sense, there's quite a lot of pressure on managers to deploy quickly regardless.
In that case, so that's the upside.
That's the upside.
Right. What are your terms?
So what's nice is that the marketplace is quite transparent in Europe. It's a senior secured loan. So the best comparison might be with your real estate loan. You take the debt, it's secured on your assets. Then you repay it progressively over 3 to 4 years. Every month you repay interest and principal. The interest rates at the moment, and they've been historically very stable. It's around 8 to 10% spread.
But when you say they've been stable as a spread over the base
over the base rate. Exactly.
But then the base rate. Obviously.
Yes, the base rate has changed. But it's like the equity markets. You look at the equity risk premium for equity markets, and in that you would look at the debt spread. So that debt spread hasn't changed a lot. It's not scientifically proven, but my belief is that it's because we are an alternative to equity returns. So if an entrepreneur is thinking either I take equity or I take debt, if I take equity, a VC fund is going to require something like 30-40% return on their investment, and debt is usually 25% of that. So I'll dilute less, and I'll pay the 10% to the lender, and that's why the rates have been stable, because the required rate of VC have also been stable over the past 20-30 years.
Just spill it out for me. What would you normally expect to happen in a rising interest rate environment to the spread?
So 2021, when the rates were zero or negative, the cost of the debt was 8 to 10%. Today, it's grown up by 2 to 3%. So it's around 10, 12%. In different markets, in the US, where the base rate is higher, there the yields are around 14, 15%. So that's what you would expect to pay. It is expensive. It's more expensive than bank debt. It's more expensive than government subsidized loans, but it's 3 to 4 times cheaper than equity on the tagline. And actually, when you look at the dilution, is 8 to 10 times less dilutive.
Yeah, so there's a huge difference between at one end normal debt provision and at the other end equity, and you're coming into this kind of massive gap where there's latitude. You have competitors. Is there a kind of a market standard, or are you a market setter?
I think it's the cost of capital that we all have. If you're a bank, like Silicon Valley Bank was, maybe your price is a little bit cheaper, 1 or 2% cheaper.
Right.
But we're all around the same levels. And what really makes a difference is what type of lenders you want to partner with. What's their DNA? What's your DNA? How are they going to react in the bad moments? Because the difficult, let's call it the difficult moments, it can be due to good things, like the company growing too fast, or the company not growing fast enough. And then you need to have difficult discussions with your lenders, with your equity investors. Who do you want to sit down with in those moments? And I think that's what really determines which lender you go to, rather than 0.5% difference. Because ultimately, as an entrepreneur, you're going for an outsized return.
Yes, of course. What about your upside? Do you have like equity options and that kind of thing?
Yeah, and what I really like is that we came to venture debt with Stephanie, my partner, because we wanted to find a way to be exposed to these amazing companies that we could see happening in Europe. And if you're not, one of the best, some of the best funds in Europe, like I said, the Axel, the Index, and you might not get into those companies. But as venture lenders, we have a chance to get into these amazing stories and to help them grow and benefit from the upside, because we have equity kickers in the forms of warrants. So we have an option to, in the future, buy shares in the company if it's successful at today's price.
So you set up Bootstrap Europe as a growth debt lender because you wanted to find a way of getting into these top companies backed by these top VCs. Yeah. And so you took a strategic decision to come in a different part of the capital structure. Yeah. So that's brilliant.
That was exactly the play. Yeah. So with Stephanie, we always believed that innovation is where we want it to be. And having both studied finance together, we graduated in 2007, 1 year before the financial crisis. We were both in London working in investment banking. Every night we would come home and say, okay, who's been fired last night? And finance had lost its meaning. In 2008, 2009, it became completely senseless. And that's not basically what we studied for. So we always thought we need to find a way to channel capital towards innovation. We need to do something in innovation. We knew we were going to do something. So we helped a lot of entrepreneurs and family offices invest in technology. And we did it through every single means possible: equity, debt, funds, secondaries. We tried a lot of things, and we found that venture debt was the one sticking the best in terms of risk return. We really liked the way it worked. We liked that it was complementary to whatever the equity and the founders were doing. So we're not center stage, and venture debt is really in the backstage of the beautiful equity stories we see. However, we do think that it plays an enormous role in keeping value for the ones who are making it happen.
Yeah, so you got to play across the capital structure and funds and directs, and then you hit upon this. So presumably your source of funds is similar to when you're you were working for the family offices and the multi-asset managers. Are you operating out of LP funds?
Yeah, so we have now a typical LPGP structure, and we found that's what has been the most resilient in the past few decades. Not the bank structure. And we are lucky that our early supporters who helped us start our business are still invested with us. We still work with them and exchange with them because they're also amazing entrepreneurs in their own merit. On top of that, of course, we have institutional investors without whom we would not get to the scale that we have today. But we have kept that DNA of being entrepreneurial and working with people who build businesses.
So let's jump to your big deal. I think it's fair to say in 2023, you bought the German portfolio of Silicon Valley Bank. How did that deal come about?
We had been working on our fundamentals for a long time. I think in our partnership, we have a person who's the only one outside Bootstrap who has ever bought a venture debt book before. So Humphrey Noakes, who's British, in the late 90s or early 2000, acquired a venture debt book from an American lender also. GATX.
So just one of your colleagues had ever done this kind of big secondary style transaction?
We had never seen that in Europe. And another one of our partner, Elliot, is ex-SVB, helped launch their fintech franchise here in the very early days of Silicon Valley.
He was already on board with you before you did.
He was already on board with us. He joined us way before all of that happened. And when SVB folded, unfortunately, we knew that First Citizen acquired the American assets really quickly. HSBC grabbed the UK assets very quickly as well. But we knew that the German assets were still up for grab. And so since March, we had been trying to get in touch with the US FDIC to understand how they were going to dispose of those assets. So they started a process led by a Midwest corporate finance firm that started it in June, just before European summer, when everybody was starting to pack up and go. Obviously we had been sharpening our underwriting knives. And so when they launched the process, we were one of the teams who had the skills to really understand that portfolio, because it was a performing portfolio, great assets in Germany. SVB had done a lot of work educating the ecosystem around venture debt, the same as they've done in the UK. So Germany was their only other market in Europe where they had like a bank presence. And so they grabbed a lot of amazing portfolio companies, often financed by US VCs. So the likes of NEA, Inside Partners, etc., that you don't necessarily see a lot in Europe. As you said, the crème de la crème. And within less than a month, we could analyze all those transactions with our team. So we also have people who have been on senior bond desks at Citi, others who knew how to do hedging and FX, others who knew how to do, NAV financing, for example, for loan acquisitions. And
so you found you had the talent in-house.
We had
even though you'd not done this specifically before.
Exactly. We're not a secondaries team, but we knew the loan book and we knew how to structure those transactions. And I think while some of our competitors were still at the stage of writing and signing, negotiating NDA with the FDIC, we had finalized the transaction. So it was a matter of speed and skills. And again, I think it's really the team that made it happen.
And what about kind of pricing? I mean, it's valuations must be difficult in that part of the market where everything's loss-making, presumably, and all is about potential.
Well, it's interesting because if you think of some of the large US auto manufacturers who were loss-making at some point, they still had very well-rated bonds out there, because even though they were loss-making, they could still pay their debt obligations. And it's exactly the same in venture debt. Even though the companies are loss-making, they're well-capitalized and they can pay their loan obligations. So the SVB portfolio in Germany was well-performing. There were a couple of positions we knew were not doing so well. We could provision them and we could really, basically risk weight them. But the rest of the portfolio did fantastic. So it was a matter of understanding where the pieces of risk were lying in the portfolio and accurately pricing it. I think only the specialized lenders could do that. We knew that some banks were bidding for it also, because we contacted them for financing and they were conflicted.
So hence your ability to be nimble, because presumably you were up against banks rather than other small providers like you, or everyone.
I think everyone who is someone in venture lending in Europe looked at it. Our competitors looked at it. Our competitors bid for it. So it was not a distressed sale. The seller was distressed, but not the seller.
Yeah, so people might not understand this. I mean, what was the problem with Silicon Valley Bank if it wasn't their portfolio?
So I was alluding to how, as a lender, you finance yourself.
Yeah.
And Silicon Valley Bank finance themselves also with debt. It's very common in the US, actually. You know, other listed lenders finance themselves with debt. We don't believe that is necessarily the right model. But SVB did not manage really well the match between their assets and the liability side of the bank. So the debt tranching and the debt maturities and the way they locked the interest rates on the liability side made it very expensive for them to repay their obligations. And so unfortunately it folded, which truly I think it was a net loss for the system when it happened. But it's impressive how quickly it recovered.
Right. Yeah, so it's a kind of a treasury management issue, nothing really to do with fundamental venture capital.
Correct. And you can see how quickly the other banks jumped into the pond after Silicon Valley Bank disappeared. So the JP Morgans, HSBC, all came into this market because you're talking about companies who have enormous deposits compared to your usual SME. You know, a venture-backed company has a couple of tens of millions on its balance sheet at any given time, the ones who are doing well. And whereas normally an SME would have very short liquidities.
Yeah.
Right. And so that, I think SVB has something like 100 billion of liquidities. You know, don't quote me on this, but I can't remember the exact number, but they had enormous liquidity that all the banks then jumped onto to try and get those deposits.
Yeah. And all this is happening as well at a very difficult time in the wider world, particularly in the technology markets. Were we kind of in the middle of a real tech slump, I think, at that point in kind of the first half of 2023? That must have affected your analysis, everyone's analysis. How are things going?
Yeah. It's true. So since 2022, basically, the shock from the Ukraine-Russia crisis, the technology market cooled down. And from the high of 2022, when in Europe you had 100 billion of technology investments, it came down 20% every year. However, I would say there's still a lot of quality investments. Because there is a saying that crisis brings opportunity. And a lot of entrepreneurs saw the advantage and the possibility from that crisis. A lot of entrepreneurs were well capitalized because we were just fresh off COVID crisis, where VCs and growth equity funds were like, oh, okay, we can't run these companies with 9 to 12 months of cash. We need to capitalize them for 2 to 3 years. We don't know if there's going to be another COVID. For sure, this bull market is going to end at some point. So our best companies are going to be well capitalized. Obviously, those are the ones you want to lend to. So when you're looking at that top of the market, they could take advantage of the more difficult conditions to grab market share, acquire smaller competitors, rationalize their cost base because there had been exuberance in the VC market. And we see companies who are cutting costs today significantly and continuing to grow on the same level. So I think it's a healthier level of growth. We like that type of growth more. We've always have. We had to say no to a lot of companies during the crazy days because we didn't like, negative gross margins or things like that, which seemed completely normal and standard at the time. But in hindsight, now everyone is turning towards profitability or lower losses. I think, which we believe it's a healthier way to build companies.
So what kind of risk return, how does risk return from an fund investor point of view compare with venture capital? Why do venture capital clients keep coming back to RW Blears for their institutional fundraising services?
Something I've noticed in the last few years is it's a relatively small community within London. Fund managers don't tend to be overly competitive with each other at the early stage. And so for those who have fundraised, and we've advised as part of a wider support group, they're very happy and very good referrers of work to those who are just starting out on the journey.
Frank, what is it about the venture and growth capital sector that interests you, gets you up in the morning?
You're not tied to any particular sector, so you see people from all walks of life with all sorts of expertise, and they tend almost to a person to be starry-eyed and hopeful and keen to make a difference and excited about what they're doing.
Question for both of you. What's the right type of client? Who listening to this should now pick up the phone, go onto the website and contact?
Say anyone who's interested in taking a next step from personal investing to raising funds from other people, and maybe they are thinking about moving out of a bigger institution, setting up on their own, make sure they do so in the right way, in the way that allows them to be able to market their offering and to ensure they don't trip up on any regulations, but also to sort of give themselves the best fighting chance of raising and deploying.
Well, look, thanks so much for being Fundshack's first corporate sponsors. It's been really interesting talking with you. And if this strikes a chord with anyone out there, your contact details will be in the show notes, or they can visit blears.com.
Thank you.
Thank you.
The reason why we're trying to get access to the best VC-backed companies is because we want to try to get similar returns. Of course, our warrants are around 10% of the loan exposure. So where a VC will make 100 times, we will make much less because we only had 10% of that equity exposure. But the distribution of returns in VC is very brutal. It's really the power law that one company in the fund is going to return the fund if you're lucky. The other ones might return the money or 2 times, and then 5 out of 10 maybe are roadkills. And so we are trying to be on the extreme side of the curve and not to lose companies. I think at Bootstrap, what we believe in is let's not try to lose our principal, and then the equity returns are the cherry on top. We will never do a loan without the equity kicker, because again, what we were really after are those equity successes. But really, I think that's what was very attractive to the preservation of capital. Not losing as much as you do in VC. But then the trade-off is not as extreme returns.
It's win-win, isn't it? If you really can provide proper Silicon Valley venture style returns within a lower risk wrapper, why wouldn't you? Wrapper's the wrong word.
Wrapper is good.
Yeah, okay, we'll go with that. Yeah, that's amazing. And so how are things going at Bootstrap Europe? Have you had to staff up in order to service the acquisitions portfolio?
So with Stephanie, when we started, we were very heavy on portfolio, managing the assets of those families and individuals. Who was a lot of you make sometimes more money by managing your existing assets than by making a new investment. And so that we knew from the get-go that we had to lock it at an institutional level. So our portfolio function is very strong. And so when we onboarded the SVB portfolio, it was 16 borrowers on top of what we already had at Bootstrap. Within 2 to 3 months, we managed to integrate that. And again, we acquired the assets, not the bank. So that was fairly straightforward. It was a lot of work, especially on the relationship side, right? A loan that you haven't underwritten, you want to make sure that you know the management team, that they know you and understand you, how you function, how we could help them as well in their growth and while they were navigating 2023. Because remember, all of a sudden your lender, SVB, goes down. You were about to raise capital and to get a new line from them, or you had your liquidity locked in, or you were in the process of renegotiating a loan with SVB. And for 4 to 6 months, there was no one there to take decisions. So there was a glut of decisions to take and backlog to go through that we went through with with that portfolio. But so far, so good, touch wood. And it was a bunch of great companies to start with. So I think it was a great experience for us also to know that we could compress and onboard so many companies at once. So give us the confidence as we embark on our new fund to ramp it up and know that we can absorb that type of volume.
So now you know how scalable your business is.
Yeah, it was a good test, a good stress test.
Yeah. And so this is an interesting area in terms of the engagement with your portfolio companies. How does that compare with a classic venture? I'm going to call it venture equity because I guess you're venture capital as well. You're in the capital structure. A venture equity investor will take a board seat and they'll be very active and say they add all sorts of value. How do you guys interact with founders and CEOs?
We are typically much more backstage compared to the VCs. Right? If you really look at how venture capital started, it used to be really operators who would hand in hand with the founders, build companies, grow companies, recruit management team, etc., find new markets. And so when you look at the best venture capital funds, they bring a lot of value to their portfolio companies. Where we bring value, it's more on the capital side, on the financing side. So as companies mature, they now start understanding and accessing a more diverse array of financing tools. So, equity is no longer the only nail you have. You can really use other things. And again, with the team, we do have a lot of exposure and knowledge about that. And we work with the founders from that perspective. But we don't sit on the board. We get the same reporting as the equity investors do and the board does. And so the only thing that matters to us is information. I think in an environment where things really switch from one day to the other, information is gold. And when you come down to it, banks usually have covenants on the loans to provide information. It's really, you're hitting that EBITDA covenant. It's just telling the banker that your profitability is going down. And in startup worlds, you don't have EBITDA most of the time. But we want that granularity of information. So we do sometimes get and maybe inquire much more than the typical minority equity investor, but we're not on the board. And so the difficult thing is that if everything goes well, we don't have to be involved.
Yes.
At all.
Yeah.
But if things get hairy for, again, it could be good reason or bad reason. Okay, we have a new contract. What do we do? We need to invest in a new facility. What do? We need to hire more sales or invest in more cloud computing capacity. We need funding, right? And in those situations, we get involved. Our role is really to, let's say, incentivize everyone to find a solution that works for everyone. It's a bit Socratic type of approach in a way. Yeah. In the best cases, we don't have to be so involved. In fundraising, in financing, we do. And because we are talking to VCs all day, literally, if a company is raising funding in a specific sector at a specific maturity, we will probably know the right investor for that one. And we will definitely help out on that fundraising for our portfolio companies.
So you mentioned the kind of the nerdy side of what you do in the technology, and you wanted to, get away from the GFC and actually back growth and innovation. To what extent do you follow kind of tech markets and innovations, and how does that feed into your analysis as well? Are there things that you particularly like the look of or don't?
I personally, for example, I'm a frustrated physics, graduate. From high school to university, I only, let's say, got off the physics track because I thought, my parents are professors, university, and I saw how much dedication it takes, time, worry, compared to your financial rewards. Yes. And I thought, no, I want to make money first. and so I dropped off the physics wagon. Same Stephanie, when we met, Stephanie was in mathematics at university. And so we always had this affinity for fundamental science because it makes such a big impact and such a big difference in everything you do. So now we are really so happy that the venture and technology world has turned more towards, semiconductors, deep tech, I won't say proper software engineering, because we feel the deeper you dig into those problems and potential solutions, the longer lasting you have an impact and the wider impact you have. So those are the companies that we like to finance, and we can continue investing in them.
What are the prospects of growth for the venture debt subsector, and what's the cap on its growth?
We've been wondering this for a long time. Because in Europe, since we started, equity has increased by a factor of 5 in terms of amounts invested in technology. And debt has increased only by 3 times max. So the penetration which we thought was very small in the beginning, was around 5-7% compared to 15-20 in the US. And we thought, wow, this is a really under-penetrated market. There's an amazing opportunity. Let's go. Now it's decreased, the penetration. Even though we talk much more about it. So I feel that there is much more awareness and there is a much better understanding and appreciation of the benefits. In some countries, debt is quite a negative word. In the UK, I think UK is the most familiar with the use of venture debt and just debt financing in general. But in certain countries, we still need to do a lot of education. And so even though we talk more about it, there is not enough volumes. There is a constraint in terms of people and capital. So people, the training that you need for growth debt, as you say, there is not a formula. So you can apply a formula to certain sectors. I'm thinking SaaS lending. You might be able to apply a formula. Revenue-based lending, you might be able to a formula. But a lot of those you can't. And then you don't have clear metrics. And then the second point is capital. I think already it's not easy to raise in venture equity and technology equity. So it's come a long way. But you don't have yet pension funds investing a lot in VC funds like you have in the US. Here, because the pension money is in the government has to invest in the venture funds. And it's trickling down to debt. Because I think now there's a clear understanding, even at the government level, that there will be a gap in the market and you will have companies selling too early, for example, because they can't grow and reach their full potential. So European Investment Bank has come with proposals. You see now banks also in Europe coming into the market to provide overdraft facilities, working capital facilities, commercial banking for startups. Frankly, I think they're not yet at the stage that SVB had, or this entrepreneurial knowledge that SVB had, because they've been doing this since the 80s. But hopefully it will increase. And for us, the more equity comes in the market, the better.
Yes.
Because then it creates amazing companies and we can finance those. And the more awareness there is, so more competitors that are specializing in different things. So revenue-based, working cap financing,
and
M&A
it could be
financing.
from traditional banking sources as well.
It's hard for banks to do the real lending because I think it's equity risk weighted in their regulatory capital. And so for them, it costs them a lot to do it. But then what we try to do now is to partner with banks. So we'll do the term loan part, the part that would cost them, and they can do the commercial banking, the working cap financing that we cannot do. And there you go back more towards what happens in buyout land. Right? You don't do all your financing with one partner, you layer it up. And that provides you a more stable and manageable capital structure.
Well, it sounds like a fascinating journey you've been on. It sounds like there's a lot more to run. I wish you the best of luck with it.
Yeah, thank you.
You've been listening to the Fund Shack podcast. If you like what you've heard, click follow on whichever platform you're listening or watching on, and visit us directly at fund-shack.com. It's got a treasure trove of private capital insights. Thanks for listening.